All right, let's dive into this explainer and uncover the really fascinating, hidden strategic narrative of Limoneira. If you follow the agriculture sector, you probably know Limoneira as this massive legacy company famous for growing and selling citrus, primarily lemons and avocados. But when we look closely at their most recent financial filings, a completely different story starts to emerge. Today, we are going to explore how this traditional farming giant is radically transforming its entire business model right before our eyes.
Now, to the untrained eye, the recent SEC 10Q filing looks absolutely disastrous. I mean, they posted a massive $31.6 million net loss just for the first 6 months of 2026. If you were just skimming the headlines, you'd honestly think this company is in a total freefall. It's a shocking number, for sure, and it absolutely demands an explanation. But peeling back the layers of this super dense filing reveals a highly calculated, massive strategic pivot.
So to unpack this massive pivot, we'll cover the big Sunkist shift, unpack those financial losses, look at their strategic asset sales, dive into real estate and water, and finish up with what lies ahead. Okay, Section 1, the big Sunkist shift, outsourcing the core.
You know, the first major clue to this puzzle is actually hidden deep in the footnotes of their report. They're transitioning away from actually selling the lemons they grow. Previously, Limoneira managed direct global sales, moving citrus to food service, wholesale, and retail customers everywhere from the US all the way to Asia. But look at this dramatic shift. The company entered into a commercial pack housing license agreement that took effect in November 2025. They completely outsourced their core lemon sales and marketing operations to Sunkist. Sunkist now grades, labels, packs, and markets literally all of it. They essentially handed the keys to their core operation right over to a partner.
And wow, this brilliantly illustrates the sheer concentration risk they took on to make this shift happen. Because Sunkist is now handling all the marketing and sales, they account for a staggering 85% of Limoneira's total revenues for the 6 months ended April 30, 2026. Even more incredibly, 95% of their accounts receivable are now tied to Sunkist. Talk about putting all your lemon-selling eggs into one giant basket. It is a huge, fundamental shift in how money actually flows into the business.
Moving on to Section 2. Unpacking the financial losses below the surface.
When we dive below the surface of that massive $31.6 million net loss we talked about earlier, the why becomes a lot clearer. They went from a $6.4 million loss in 2025 to over $31 million in 2026. A 5x increase in losses looks terrifying on a balance sheet, but, well, the secret is really in the accounting, not necessarily in the daily operations of growing fruit.
So here is the absolutely crucial point. This isn't just about selling fewer lemons. They took massive paper hits just to clear the deck for a transition. They recorded a $9.3 million impairment of assets, a $7.8 million loss on disposal of assets, and a $5.7 million historical translation loss, which is mostly tied to foreign exchange when they shifted functional currencies. Basically, these are large one-time accounting hits meant to clean up the books as they dramatically change direction.
All right, Section 3, strategic asset sales, liquidating to pivot.
Notice how aggressive this liquidation is. In November 2025, they sold off agricultural properties in Chile for nearly $15 million. Then, fast forward to April 2026, they agreed to sell an 80% stake in windfall farms in California for $16 million. And actually, that's what triggered that $9.3 million impairment hit we just talked about. Right around that same time, they completely shut down 600 lemon acres in Arizona. They are actively tearing down their traditional farming footprint across multiple geographies. Now, that Arizona shutdown in particular is fascinating. It cost them $7.1 million in disposal losses on paper, but their stated strategy in the filing is incredibly telling. The goal is to, quote, monetize Class 3 Colorado River water rights by conserving water via crop substitution to low water use crops. This reveals their true goal, prioritizing lucrative water rights over traditional farming. Out west, water is quickly becoming way more valuable than the fruit you can grow with it.
And hey, this isn't just some wild theory. It's right there, heavily documented in their financial disclosures. They are deliberately taking these short-term farming losses to fund long-term, higher-yield asset plays. They're literally cashing out of the dirt and trees to capture the real value of the resources and the land underneath them.
Which perfectly brings us to Section 4, real estate and water, building the future.
So what are they actually building with all that newly freed up capital? Well, they're transitioning from growing lemons to building real estate. Right now, they have 3 massive active joint ventures turning unused or underutilized land into housing and industrial infrastructure. First, we have East Area I and II, which is a major partnership with the Lewis Group for residential and commercial development. Second, they're actively pursuing housing development at the Limco Del Mar Ranch to address Ventura County's housing needs. And third, they formed Agramine Limoneira LLC for industrial organics recycling.
But is this real estate pivot actually paying off? Absolutely. Their East Area 1 joint venture alone has already closed on over 1,200 residential units. That has resulted in a staggering $25 million in cash distributions to Limoneira since the project's inception. That is cold, hard cash flowing right back into the company, proving that this land development strategy is way more than just a concept on paper.
They're also expanding heavily into infrastructure with Agramine Limoneira LLC. It's a 50-50 partnership to build and operate an organics recycling facility right on company land by 2027. Limoneira even made a $1.2 million asset contribution and extended a $5 million line of credit to get this built. They are fully cementing this infrastructure pivot, effectively becoming a landlord and financier for industrial environmental projects. Crazy, right?
Finally, Section 5. What lies ahead? Risks and rewards.
Of course, a transformation of this magnitude doesn't happen without some serious hazards. First off, they have to ensure that the massive sun-kissed transition actually works seamlessly. They also still face the inherent volatility of agriculture, things like unpredictable weather, potential disease, and disruptions in water supply. But now they've compounded those traditional farming risks with the very real risks of financing massive real estate developments in a highly inflationary environment with fluctuating interest rates. They are juggling 2 totally different types of massive business risks all at once.
So I'll leave you with this to ponder after looking below the surface of their 10Q filing. We've seen the massive sell-offs, the sun-kissed outsourcing, the calculated pivot to water rights, and the multi-million-dollar real estate cash flows. Based on everything we've just uncovered together, what kind of company is Limoneira today? Are they really still a lemon company at their core, or have they successfully transformed into a real estate and water rights giant in disguise? It's a really fascinating pivot, and we'll definitely be watching to see how it plays out in their future filings.